we always had this many macro risks. It's that they didn't actually come to fruition in the economy all at once.
That's Karen Harris, Managing Director of Bain's Macro Trends Group. Despite her considerable experience tracking macro risks, she's never seen a confluence of factors quite like this.
Many of the risks that you and I have been talking about for years, rising rates, declining workforces, demographics, geopolitics shifting, they set the stage for a transitioning economy, and then we had a pandemic, a kinetic war in Europe, and boom, the risks that we were aware of in the periphery became a crucial part of how we think about the operations of businesses.
Today on the show, Karen and I will discuss this unprecedented convergence of macro risks and how investors can game out the possible outcomes for the global economy, from best to worst case scenarios. I'm Hugh MacArthur, head of Bain's global private equity practice, and this is Dry Powder. Karen, thank you very much for stopping by the show today. I know you're quite busy.
It's great to be here, Hugh.
We don't talk a lot about the macro world in Dry Powder because we're so concerned with the micro world of what makes a good deal and how investors can actually generate excess returns for all stakeholders. But it seems like the macro has become a lot more important in the last 2 to 3 years. We have inflation, we have interest rates going up, we have war in Europe, biggest since World War II. The investors that I talk to are worried that they just don't know what's going to happen. Like, is this going to be ordinary, quote unquote, recession, a severe recession, weird things like extremely low unemployment in parts of the world, and we have excess savings from all of this stimulus. We have things that are not the same, quote unquote, as they are in a, if I can use the phrase, typical recession. So what do you say to investors about, I've got this, dog's breakfast of factors. A lot of these things are happening. They're not possibilities. They're real. What's an investor to think about? Where is all this potentially going?
You had mentioned at the outset that smart investors weren't talking about macro for the most part. Now its primacy in a conversation around a portfolio and investment has shifted from a plan then do mentality. Let's get a base case that with our experience looking across our portfolio makes sense, and then we'll just execute. We'll get the right price for our deal. We'll get a good value creation plan in place and so forth. Now it has to be a set of scenarios. We are so dependent on central bank policy for the near term outcome. And even central banks don't know how tight is too tight. In a post-COVID, post-global world, we will see structurally higher inflation. Now, whether that's tamed through higher interest rates or it's allowed to run is a question that is only answerable by policymakers and central banks in regions. And that is an important element for every investor to think through, and very different than the last era that they've been through.
That's a really good point, because we spent almost all of the last 20 plus years getting more and more efficient at everything we do and driving costs down to the lowest imaginable level. And in almost every industry sector in a post-global world, that's going to change. We're now reversing that. Words like resiliency and redundancy are becoming more important. And that means higher cost. It does not mean lowest imaginable cost. It means being able to get what you need when you need it. And that at times is more expensive.
Well said. I will say that inflation is incredibly destabilizing and pernicious. And so I would hope that we see some commitment to taming inflation in a meaningful way. But if that commitment wavers, then we could end up with a stagflation or a spiky scenario. And so really thinking about how robust is my business to all of these different outcomes? What does that mean from a liquidity perspective? I think one of the lessons of 2007 to 2009 for private equity companies that I remember you talking about specifically, one is put your head down, hold on, survive this. And two is liquidity and balance sheets really created massive leverage. It feels like those apply today. I don't know, does that resonate with you? And what are you hearing from clients?
It does resonate with me. I think many GPs are still stuck in wondering, what exactly do I need to prepare for? One thing that COVID did was provided a tremendous amount of clarity when the world locked down about what we exactly needed to prepare for, right? The situation was very clear. No one's going anywhere. We're all in our homes. So therefore, it's maximum cash on balance sheet, maximum discretionary cost out, and try to ride this out if you were in an industry that was adversely impacted by a situation like that. I think what we have here and what you're describing in terms of scenarios is that the range of potential outcomes is much, much wider than what most investors are prepared to game plan for. If there's a mild outcome, then I could be massively overdoing things and stressing businesses in my portfolio and perhaps underwriting things that I don't need to underwrite. And if things are extremely severe, maybe I'm not doing enough. And so as you think about these macro factors, like what do you see as kind of the best case scenario from where we are right now? And then what's the worst case scenario? So at least the investors can start to bound, what are the range of things I really do need to start thinking about?
The planning corridor that we think is the most rational right now is the best outcome is a normal recession. If your business has been around for a while, 1990 is not a bad frame of reference for what a normal recession looks like. That means a couple quarters of negative GDP growth. I think it's important not to get too wedded to the label of recession because consumers react in the face of their wages, their prices, what they're actually seeing in their lives. They don't say, well, gosh, it's not a recession, so I guess we're good. That's just not how people think. It's like when companies use overall GDP to forecast pet growth in a market. Well, dogs don't have puppies because the trade balance improves. Like that's just not how things work. And so the reactions of consumers that we're seeing, the stress on households looks a lot like a recession. Overall, I would say 1990 is not a bad best case scenario right now.
So if I can sum up and correct me if I go wrong here, what you're saying is that the Fed, just to use the United States for an example, and I'm going to go outside of the United States in a moment, they're going to use the blunt instrument and they're going to raise interest rates until consumers stop consuming and businesses stop investing, and this gets fixed by a recession. That is kind of the baseline assessment of what's going to happen. We don't have any fancy new subtle tools that are going to somehow tame inflation and give us a soft landing.
Yeah, it's a pretty good summary. I mean, there are other ways to do it, like if we believed that there was commitment to fiscal discipline. So, yeah, we don't believe that. And inflation may break before a recession because people can't afford stuff and stop buying and get worried. But that's what a normal cyclical recession looks like, even with this abnormally fast business cycle we've seen post-COVID.
So investors should be running recession cases against every single thing that they own and every single thing that they might buy. That has got to be the smart thing to do in any scenario.
Absolutely. On the downside, a scenario, we could have a recession that looks a lot more like 2007, 2009. And in order to move to the longer, more protracted recession, we'd need a trigger event like we saw with Lehman Brothers, right? We were in the middle of just a normal bog standard recession in 2007 to really 2008 when we had the collapse of balance sheets that began to ripple through the world. Mm-hmm. And there are always a number of candidates for that. Will there be some sort of sovereign debt crisis? Not a Sri Lanka, but one that ripples. Is there another economy on the verge? The usual suspects actually look to be in better shape relative to their histories. Their balance sheets are reasonably strong. So we're not looking at a Southeast Asia or a Brazil, but there may be other candidates, and you never know if somewhere in the system there's an AIG that's got unhedged exposure to something.
So let's just continue to explore these risk factors outside the US. Let's talk a little bit more systematically. Just kind of walk me through North America, EMEA, Asia, and what do you see as the major macro risks by geographic area that investors should be mindful of right now?
So in the US, I think Richard Fisher, I love to quote his view that the US economy is the prettiest horse in the glue factory. The risks are concentrated more in the capital markets. On the real economy side, housing in some markets is very concentrated in the hands of investors. And when the bets move against them, does that create pressure on housing prices? Interestingly, the NBER just published some work showing that even though we all believe that the subprime crisis came from marginal borrowers who got caught on the wrong side of rising rates, actually a lot of the shifts came from institutional investors, a lot of the losses initially. And I do wonder if we have that exposure again. But in large part, the real concern is that the US is exposed to global borrowers and that there's some financial market player in a market that is at historical records, right? Financial assets relative to real GDP. It's come down a bit from the recession, but this is just a massive financialized economy that somewhere in there, there's a risk exposure.
So we're still in the glue factory, but it's really the equity and credit markets that we need to worry about, and that the real economy hopefully has a lot more stability and the ability to snap back more rapidly, therefore, when we come out of this. Is that the takeaway?
Yeah, I wouldn't even call it snap back because so far it's actually performing okay. What could be an unexpected good outcome for the US is if we had a major asset repricing in housing or even in the equities market that would strengthen the bottom 80% of US households. And that would create a base for US spending and growth going forward after we've seen this big stretch in wealth disparity based on increasing valuations, which, as you noted earlier, comes from a rate environment that was going down, 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 and multiples expanding up, up, up.
That's an interesting take on the United States. What do you see happening in the UK and Europe?
The UK and Europe are really the epicenter of the energy crisis. Our energy and natural resources practice had a really interesting take on this, which is essentially the world's energy markets worked really nicely with a cushion of available natural gas. And that's gone. What we've discovered is molecules aren't fungible. If you set an LNG terminal on fire by accident in the southern United States, you don't have regasification facilities in Germany. Voila, it's very hard to get natural gas from other parts of the world. And of course, we're seeing that in the futures prices. Add to that what's happening with Russia and Europe trying to wean itself off of Russian natural gas. Without Russian natural gas, Germany's really going to struggle. Even if they manage to fill their inventory to 95% this year, which they were on track to do until the Nord Stream 1 repairs. I put repairs in air quotes because it does feel a little bit like Putin's toying with Europe on that front. But even if they fill their storage, that's not meant to be a strategic reserve. That's meant to be a short-term solution. A cold winter could deplete that very quickly and would create problems for the following winter because the storage levels would be even lower. And so we see these prices spiking in Europe in a way that is driving an enormous amount of inflation. And that's just going to be a struggle for Europe. For the Eurozone itself, the challenge is the very different outlooks for different parts of that same economy, that same currency, same interest rate. So you have Germany, really the worst hit, for which Germany needs a different monetary policy than Spain, who is not only less inflationary, younger, but also they have an unemployment problem, but not really an energy problem because of the pipelines from North Africa. So you have one medicine to cure a lot of ills and a bad sickness in terms of the near-term energy situation, which is going to create a lot of challenges for Europe in the near term.
So it sounds like, generally speaking, in a lot of markets, we're going to see the price of energy go way up, the availability of energy be challenged. And so when I'm looking at my current portfolio or anything that is highly energy dependent in a lot of European markets, I really need to focus in on that and how that might behave over time. There are a lot of other factors in the Eurozone that are kind of messy, right? Well, what's good for one area is not what's good for another area. So really picking apart drivers of demand, how different policies will impact different markets and those demand drivers is going to be important in any multi-geographic asset that I'm buying.
I would just add to Europe that it's not just energy but also food prices and more profoundly chemicals, because the feedstock for a lot of chemicals comes from byproducts of natural gas. And energy shows up behind in a lot of places like bottle making, packaging, plastics. My biggest worry is that as humans, we tend to think linearly. And I would just push investors to think about a worst case scenario than they might be comfortable thinking about. What would happen if you can't get energy molecules that you need at any price on the continent for a period of time? What would that look like? And that doesn't mean you don't invest in places, but it does mean, to your earlier point, you need to have the liquidity to support those businesses through what could be a pretty rough ride.
Is there anything in particular that stands out in the UK that you see that is different from Eurozone types of pressures?
So for the UK, it's hard to know how much of the supply chain snarl is COVID versus Brexit, because we shut down the UK as Brexit would have been impacting it. So teasing apart those factors is difficult. The good news for the UK is that it has its single monetary policy that it can use for its own economy. The tough news is it's just grappling with much higher inflation levels than the continent, which could mean a stronger push on the brakes in the near term.
So we could see divergent monetary policy in the UK versus the Eurozone, as well as potentially different and more compelling supply chain problems in various sectors.
Yes, I think the Eurozone may need to move into yield curve management because it's going to have to manage the debt spread between Germany and Italy's ability to pay its own debt in a way that the UK will not have to think about as quickly.
What about Asia and the Asia Pacific region? Any major factors that investors need to take into account?
We're not beyond COVID in China. And of course, that's still impacting the global economy. We still have supply chain snarls that we're working out. So the continued move for multinational companies to diversify their manufacturing base, and the word diversify is really important. We're not seeing companies say, well, I can't manufacture in China anymore. We're seeing that they are looking at a China plus one plus two, China for the Chinese market and other countries as options for manufacture of goods. That's put a really nice tailwind for Vietnam, for Thailand, even Malaysia, in looking at being an alternative. We've even heard about companies thinking about moving supply chains to India, which is a brave, often challenging path to take. Japan has been a solid performer and has been at the vanguard of macroeconomic experimentation. Their recent results have been stronger than markets expected. And I think for investors, what's fascinating about Japan is the cutting edge in so many different types of automation, robotics, combined with this period of intergenerational transfer when you have octogenarians looking to turn over their businesses to a generation that's not always interested. That feels like a very interesting opportunity. So Asia's more solid. They are well insulated for the most part from the kind of currency crisis we saw in 1997 because they've become much more aggressive about keeping foreign currency reserves.
How relevant is the pandemic to what we're thinking about in terms of underwriting investments and the global economy today? Is it still something we should be talking about in the present tense, or are there other factors that are more important at this point in your view?
Yeah. Well, we still have supply chain challenges. We're still moving from what was a service and goods economy to boom, lockdown, goods-based economy to yay, we're out of our houses, back to services. And services, of course, are much less productive in terms of human labor. You need more people per output. And so we have the labor shortages and the management problems and all of that. I think the more fundamental impact is that it was such a de-anchoring of expectations. If I had come on Dry Powder in 2019 and said, next year, I think you should just let everyone work from home all the time. You let me know if that's going to work. People would be like, okay, that was an interesting podcast. I'm going to the less crazy channel. If we'd said we were going to create $31 trillion of wealth, 24% increase in wealth in 2 years, that would have sounded demented. And I think all of these de-anchoring effects have changed expectations for what governments will do, expectations for intervention, and that is a more profound effect. So we are still living in a post-COVID world. Some is the actual direct impact of COVID, and some of it is what it did to mindset.
On the next episode of Dry Powder, Karen and I will discuss how investors can connect these sweeping macro trends to their investment strategy on the ground.
The trap that we often see is you get a base case that you feel really good about. You build a consensus in lots of detail, and then you torture it up and down 20% and call that scenario planning.
I'm Hugh MacArthur. Thank you for listening.